Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We've got lots of great things to talk about every week on the show, but this week it's one of our favorites. It's you. Yeah, your questions, our answers. We call it Ask the Guys. We've got some great ones today on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it's our co-host and financial strategist, Russell Gray.
Hey, Robert.
You know, one of our favorite things to do is reach into the electronic grab bag and hear from our listeners. And we did this a few weeks back. We'll do it a few weeks from now, but we love to do these shows where you send in your questions and we make up answers. It's called Ask the Guys. Got a bunch of great questions today. Here's how it works. You send your question to ask at realestateguysradio.com or go to the website at realestateguysradio.com and click the button that says Ask the Guys and tell us what's on your mind. Now, we have a couple of disclaimers. First of all, we don't give advice. We give ideas and information. And we're also not tax or legal professionals. We may have some ideas when it comes to taxation and legal issues, but we'll always urge you to seek professional counsel for those issues. All right, with that behind us, let's start with our first question. This comes from Joe in Tabernacle, New Jersey. Thank you guys for providing so much great information on so many topics. I recently decided to invest in foreign agriculture thanks to you. My question, however, is based more on single-family rentals in the United States. What would you consider a good cash-on-cash return in your opinion? For example, if I purchased a single-family home with conventional financing, 20% down, after all expenses, I typically like to see a cash-on-cash return of 10%, but no lower than 8%. Any lower than that, I feel, is risking future negative cash flow in tough times, and anything above about 15%, I get concerned it may not be in a great neighborhood, and there might be high turnover and repair cost. Is this thinking accurate? Thanks again for all your great information. I look forward to hearing from you, Joe. All right, Joe. Well, great question. First of all, I know Russ, our financial strategist, is going to have some ideas to get your mind around, but I'll just say that I have found in my years of investing, there is no magic formula number. There is no particular number at which it's a good deal, and anything above that is great, and anything below that is bad. It's always, and it depends. It depends on the market. It depends on how well you've researched. Generally, lower gross rent multipliers, meaning that you don't have to pay as much for the stream of income. If you just were to look at the GRM and it's low, that probably tells you it's probably not the greatest neighborhood, and high GRMs generally are in A-class neighborhoods, but that's not always true. And so it's not just about the percentage of return, it's about the whole picture.
Well, it sounds like you're working off pro formas, and I used to joke about this pro forma being Latin for made up.
Yeah.
And the problem when you see those higher yields is it's probably hiding a lot of turnover expenses, so you're wise to be suspicious of that. So that first cut, that GRM that Robert talked about, is just a way to kind of gauge where a neighborhood is at. But what you really have to look at is the net operating income. That's how you calculate the cap rate. But your real question is the concept of what is a good return. A good return is something that is positive relative to the amount of money you spent to get the capitals. In other words, if you borrow at 4 and earn 8, that's good. If you borrow at 10 and earn 8, that's bad.
Right.
There are 4 components to return that you need to look at. 2 are on the profit and loss side and 2 are on the balance sheet side. So the 2 on the profit and loss side, first one is net operating income, cash flow on operations, gross revenues in, operating expenses out, net operating income. But it's not monthly, because you have things that come up maybe every 6 months or every year or turnover, depending on the term of your leases. And so you have to use some averages and some estimates to figure out what that number is really going to be. And you learn doing that type of underwriting just with experience and knowing your market and having confidence in your management team. If you're doing that level of due diligence, you probably want to have your property manager involved with you early in the game, because they're the ones that are going to really know what a real property is going to operate. Real estate agents, we love them, but they're interested in showing you some sunshine so that you'll sign the contract and do the deal, right? That's just the nature of the beast. The second area on the profit and loss statement is your taxes. And that is when you get done, most investments in the world, when you have a profit, you pay tax on that. So your after-tax cash flow is lower. But real estate, your after-tax cash flow can actually be higher. And that's where you got to get your CPA involved. So that's two components on the cash flow side. The other side is on the balance sheet, which is amortization, the pay down of the loan, which is reducing your debt and increasing your equity. And typically that's about 1% to 2% a year at today's interest rates. If interest rates were to go higher, it would be a little bit different. You can get into an amortization table and look at that and you can see that. But that's an internal rate of return, if you will. And the other one, of course, is appreciation. And the real appreciation effect is going to be based on how much leverage. In other words, if you have a property that goes up 2% and you own it 100% cash, you're going to get 2% on your capital. If you own it at 20% down, you're going to get 2% on all 100%, but you only got 20% of your capital in, and you're going to have a 10% return there because it would be 2% times 5-to-1 leverage. And when you put all that in a blender, your internal rate of return on real estate is quite good. It's quite easy to hit a 20% annualized return, if you will, or growth over a longer period of time, and real estate should be a longer hold. So the key is to put to the bottom line is a good deal is one that you can reasonably control for the long haul. And if you do that in the right market, your overall return when you exit the property, either through a refinance or a sale, is probably going to outperform just about anything else you could do.
When Russ talks about those 4 ways that we make money in real estate, you put all that together, and a lot of people call that internal rate of return, which is just a little bit confusing term. So we call it total return. It's just all the ways you profit from owning the property. So I want to address the other part, and it was all awesome. Here's the part is that you mentioned, and this is good thinking, that tough times could be coming. So if I'm thin when times get tough and people can't pay their rent, or I don't know, there's a pandemic or something, right? Having some cushion in there makes sense. Okay, that does make sense. So that's called underwriting. You're taking a look at the durability of the market and the rents in the market. What's your best guess as to the likelihood of somebody wanting to rent this unit? And so if you are picking the right markets in the right neighborhoods, you'll be okay there. But there's a bigger picture. That internal rate of return doesn't stay constant, that total return number, because over time, rents do go up. Amortization increases, your equity goes up, and if you do it right, you get to the end of 15 or 30 years. Now, not everybody holds property that long, but if you did, the mortgage is paid off by the tenant. You now own it outright, so you've made money from the appreciation. Your cash flow is probably better than it was before. Your expenses might have gone up a little bit because it's an older property at that point. And the tax benefits, well, those are the tax benefits, and that changes, it changes, but it's been pretty solid and pretty consistent for many, many years. So there's more to it than just cash on cash return. That's my point. If my thinking is I'm going in for strictly cash flow, then I'm going to maybe choose differently than if my thinking is, hey, I want it to cash flow while the tenant pays down the mortgage and while the property goes up in value. You see the different shift in mindset? If you have a 3-year hold horizon, well, frankly, you're going to probably lose most of your return in the costs of selling. Real estate takes 8 to 10% sales costs every time you make a move, but not if you hang on. And so that's why we're believers in long-term buy and hold real estate of all kinds. Great question, Joe. Our next question comes from Melissa in California City, California. Hey guys, I've been studying for over 4 years, and after listening to you, I finally got the guts to purchase my first rental. Hey, awesome, Melissa. It's a $370,000 fourplex in a small but growing city. We say we have a cash flow of $600 a month, but that's not actually true because we're paying a low-interest loan taken from retirement back to ourselves at $800 a month. That loan will be gone in 5 years. It's also ignoring the fact that we have a balloon payment at 15 years if we don't increase our principal payments to accelerate the payoff. After 10 months of just watching the money manage itself, it's gotten boring already, and I'm just dying to grab my next property. What should I be considering before making that step? Should I have a certain number of months saved up? Should I wait for the current down payment loan to be paid off first, etc.? Note, we have a household saving rate of about $1,000 a month, so waiting gets us more dry powder. Thank you guys for all the insights you've given. I've learned so much. All right, Melissa, well, this is a great one. First of all, congratulations on your first property.
Education for effective action, so that's good.
That's great. And love fourplexes. And if you don't know why we love fourplexes, it's because it's the most number of units you can get with a traditional loan. And the 1 to 4 unit loans in residential or residential loans, above that they go to commercial. It's a whole different ball game. So love fourplexes, and they have the diversity. You know, a single family house is either 100% occupied or 100% vacant, but a fourplex is rarely either of those things. So good job. Now, as soon as you get a little taste, you want to have more. So I don't know how much you want to delve into the loan of the retirement part, Russ, but the big picture is, if you are looking to acquire your next property, there are lots of things to be thinking about right now.
Yeah, well, there's a couple things. One is, first, just doing the math is putting all the costs of capital in one blender and figuring out what the cost of capital is and what the asset is returning to you. And then, per our previous discussion, you have to decide if that makes sense. If you're in it for the long haul, to the previous point, it's less about the return as it is just making sure that you can stay in control for the long haul. Sounds like you're a conservative person. You believe in having reserves. That's great. You've spent 4 years getting educated and another year or so getting real world experience. That's all very valuable and it's marketable. You know, if you listen to the show, it's no secret we love syndication. Why do we love syndication? It allows you to monetize your education. It allows you to monetize your experience, because somebody who's further behind than you would love to have you be the mentor who brings them up to where they're at. So you can bring on a credit partner if you need credit, and you bring the down payment, they bring the credit. You may bring the deal or the expertise, and someone brings in some money and you bring the credit, or you have 3 people that all come together. Here's the point. When you add more people and more properties to your dealings, you add diversification, you diversify risk, you mitigate risk. And the more you add, you get a little bit of it. So if you say, for example, you get 10% of 20 deals, that's more than getting 100% of one deal. And you have more diversification, more experience, grow your resume. Now, not everybody wants to go into syndication, and we get that. But if you sound like you love the business and you want to do more, and the way you do more faster is to involve other people who have saved more money, maybe earn more money than you, and they're busy doing that, and they don't want to do what you do. So I guess what I'm saying is appreciate the value of your 4 years of education, your ability to take action, your conservative approach to managing money, and your year of experience. That's all worth something to somebody, and I think you go find those people, and you'll be doing a lot more deals real quick.
How much you need to have saved up to do a deal? Well, that depends on where you're buying and what you're buying and how much you need down. But I'm guessing you're pretty close right now to being able to do deal number 2, as long as you feel confident that you have those reserves. We're just going to talk about that later because somebody has a question about that. But you're on the right track, Melissa. Keep getting educated. Get around people that are doing it, and maybe consider syndication. It's Ask the Guys. Your questions, our answers. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Are you an accredited investor looking for reliable cash flow with some additional upside? You probably realize that energy drives all economic activity. The COVID-19 global slowdown created a temporary crash in oil prices, which in turn opened up a tremendous but little-known opportunity. This unique situation has allowed a seasoned team of oil professionals to craft a compelling structure that locks in profit when oil prices are low, while capturing significant upside when prices increase. And this offering leverages proven oil production, not risky exploration. Sound intriguing? Then your first investment should be the 20 minutes it takes to watch a short video that will detail this high-yield passive income opportunity. Simply send your email request to blueridge@realestateguysradio.com. If you're an accredited investor looking for predictable yield with sizable upside, email Blue Ridge at realestateguysradio.com. That's Blue Ridge at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Hi, this is Chris Martinson, author of Prosper, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you've ever wanted to do bigger deals using other people's money, or if you want to passively invest inside folks that are doing that, coming out to the secrets of successful syndication happens the last weekend in March in the new year. We've got a lot of folks already signed up. We'd love to add you to that list, and it's live and in person. All the details on our website, realestateguysradio.com, under events. It's Ask the Guys. Every 6 to 8 weeks, we like to reach into the mailbag and see what our listeners are wondering. And we've got a bunch of great questions today. This next one comes from Chase in Houston, Texas. Hi, I've been a fan of you guys and your interviews. I'm interested in both active and passive investments in real estate. What are the requirements and qualifications of each? Thanks, Chase. All right, well, big picture is 2 ways to invest in real estate. One is active, meaning you do the work. Maybe you roll up your sleeves, you're out in the marketplace, you're doing the legwork and the homework, and you're meeting the broker, and you're talking to the lender, and you're picking out the paint colors, and you're deciding the floor plans, and you're hands-on. The other side is you hand your money to a professional fund manager and don't worry about any of it. Now, obviously, there's a lot of in between. And so there's no one size fits all in that. We were just talking previously about this idea of syndication, and there's 2 sides of syndication. The active person puts the deal together, finds the market, finds all the players. The passive person vets the deal, takes a look, understands the timeline, what the expected returns are, what the tax benefits might look like, and then makes an investment. So they do have different requirements. Let's talk first, Russ, about the requirements of an active investment, which have to do with typically qualification.
So if you're going to be an active investor, meaning you're going to purchase properties and put them in your own portfolio with your own money, well, first of all, you have to have the money.
Right.
Second of all, you have to have credit. Probably you're going to want to use credit, which means you're going to have documentable income, a decent credit score, and a balance sheet. If you don't know what those requirements are, your first stop is with a mortgage professional who will underwrite you, if you will, and give you a borrowing power analysis, at least that's what we used to call it, and assess what you're capable of doing based on what the current lending environment is. Armed with that, you can begin to go shopping. Of course, to go shopping, you need to know what you're looking for. That starts with your personal investment philosophy, what you're trying to accomplish, and then you need to build a team or at least some people who can help you find the market, find the property types, and not just find them and get the deal done, but actually manage them after the fact, unless you're going to manage them yourself. If you're going to manage them yourselves, Robert could probably talk a lot more about that than me, but I'll tell you, you really have to know what you're doing, especially in certain states because they're very tenant friendly. And if you get it wrong, you can create a lot of problems for yourself legally, financially. It's a lot of brain damage. So, that's the active side.
And I think that's great for a lot of folks. In fact, Chase, we have many, many listeners that have portfolios of property and they own properties or they're rental properties. Some of them are brave or crazy enough to manage the property themselves. I got a guy I know who has 100 properties, single-family homes, 100, and he manages the portfolio himself. Now, I tell you, life is too short to manage property. I think you want to get a qualified, professional, awesome property manager to do that job. Sure, they charge some money, but they generally charge a percentage of collected rent, and it's a small percentage, and it's worth it. So that doesn't mean you're not active because you're still figuring out the market and looking at properties and walking through properties and deciding what's going to make the best sense as a rental and all those things. So active doesn't have any kind of qualification other than you need to have the financial ability. Either you've got a bunch of cash or you have the wherewithal to borrow. Let's talk about passive. Passive investing can have some requirements, but it doesn't have to. Here's what I mean by that. If you're passively investing in something like a real estate investment trust or a home builder's stock, those are both real estate investments that are completely passive, but they're very different than what we call a private placement, where you put your money together with that of other people to buy a bigger deal, what we call a real estate syndication. We were talking about it before the break. And in that case, as a passive investor in real estate syndication, depending on the deal, there may be some requirements.
Well, and there's also one other little level in between, which is like an equity share. You know, you can contribute a credit score or a down payment and let someone else contribute the loan or live in the property, or you get a tenant. So there's ways for you to partner that isn't really considered a security. And again, we're not giving legal advice, but you know, anytime you're passive means certain things. From a legal perspective, it means the responsibility of making the money is 100% on somebody else's, and you're not a principal. Right? So that's what it means. To do that, then there are legal requirements that are imposed upon the person providing that private placement. They either have to have a substantial relationship with you and know you and have the basis of understanding that whether this would be suitable for you or not. And you have to have the sophistication to understand what you are looking at. And so that's a Reg B. Reg C is accredited, which is where you need to have a personal income of $200,000 a year or more for the last 2 years, and expect to do that again this upcoming year, or $300,000 as a couple, or a net worth of over $1 million, excluding the equity in your personal residence. The government then deems that you're wealthy enough that you can afford to make a dumb decision, or that you're sophisticated enough because you've made all that money that you know what you're doing. For whatever reason, if you don't fit those qualifications, you can't get into a lot of passive investments. So there's that passive space where you are a principal in a property and you've contributed something, but somebody else is doing most of the work, and that can feel very passive. Or you can actually buy a security as a passive investor, either a publicly traded security where you don't have to have any qualifications other than being able to open up a brokerage account, or a private placement where you have to have either a Reg B or a Reg C status.
Now, Chase, stay with us, because your question is going to kind of dovetail into the next question, which comes from Jason in Dickinson, Texas. Hello, guys. When listening to multiple podcasts and real estate experts, I always hear them mention getting involved with investing in passive syndications. My question is, how do I get into a real estate syndication when I'm not quite an accredited investor? I currently own 6 rental properties and have a couple $100,000 to invest, but I'm just shy of being considered accredited. Any suggestions would be helpful. Do rental mortgages count against becoming an accredited investor? Okay, so I thought that might fit nicely into Chase's more introductory question, and here's the reality. There are, as Russ was just mentioning, certain passive investments that you don't need any kind of security regulation for. I did a couple of those early on where we had some folks who had the wherewithal and the energy and the enthusiasm to go get their hands dirty and wanted to go buy some properties, fix them up. They were just missing some money. I would come in and partner as the money partner. I put the down payment down. They'd do the work. We'd split the money. It was awesome for them. It was awesome for me. So that doesn't take a lot. On the passive side, if you're under the exemption Russ spoke about, the 506B, that means someone raising money who chooses that exemption can have up to 35 non-accredited investors. So Jason, right now, just looking at what you have, you would be able to participate in a 506B syndication, because not every investor must be accredited. Accreditation, though, is a hard and fast rule for 506C. Most syndications, and the best syndications, frankly, are probably for accredited investors, and that's by design. In fact, Robert Kiyosaki's book, Rich Dad's Guide to Investing, opens with a story about Robert wanting to put money into a deal that his rich dad and his son, his friend Mike, were doing. And they looked at him and said, well, actually, you can't put money in this deal. And he's like, well, why not? And the answer was, he's not accredited. Now, in that book, Robert didn't use that language. He just said there's certain ways that people have to qualify, but that's what he's talking about, is being accredited. So if you're knocking on the door of accreditation, that's great. Keep up the good work. Unfortunately, there is no, hey, I'm almost accredited, can you let me in?
No, I think what you want to do is concentrate on Reg B. And again, you don't have to worry that much about that. The real bottom line for you is to network. We say all the time that real estate investing is a relationship business, and it absolutely is. Syndications is definitely, private placements, definitely a relationship business, which means that you want to get out there and you want to start to network with people who are putting syndications together. Get to know them, spend time with them, let them get to know you. There are literally checklists of what you have to do or what they have to do to prove that they have a substantive personal relationship with you, and they have to have that relationship with you before they put the deal together. You can't do it. You can't buddy up with somebody to get into a deal they already have. You have to find them before they have the deal. And the other thing is continue to work on your sophistication. You're already doing great with that. I don't think you're going to have any problem convincing somebody that you're sophisticated enough to understand the risks and the opportunities and the workings of the deal that you're looking at. So, but it's relationships. If you have those relationships, if you have relationships with lots of people that are active in the space, believe me, it will not be long before deals come your way. And this is not the kind of business that you just do sitting in, the basement on the internet. It's just not that way. You got to get out and meet people. That's why we're back to live events, and we're going to continue to do that as long as we're allowed to do that, because we love networking. We built a whole career on that. We have a big tribe of people that get together every single time they can. They learn from each other, but most of all, they build those relationships, and they always end up doing some business together. We're not matchmakers. We don't do that, but we are hosts, and we let people get together and meet each other, and then what happens, happens.
Well, in fact, we're just coming back from an event that you haven't heard advertised, you haven't heard a spot, if you will, for, because it's for our private syndication club, and they've been itching to get together. We've been doing the events virtually, and this was our first test run to be live in a room and socially distant and all that. And so we've got live events coming up on the calendar, which is going to be awesome. A couple more things here, Jason. You asked if rental mortgages count against becoming an accredited investor. Well, no, because a mortgage is money you've borrowed. It's an obligation you have, but it doesn't count against your net worth. So the requirements of income, it doesn't affect your income. Obviously, whatever you're getting in net from a property would affect your income. So I guess in a roundabout way, maybe if you didn't have a mortgage, right, and you had more income coming in, then you might get that $200,000 a year qualification. But generally, your mortgages don't count against you for accreditation period.
Yeah, I think the thing to remember is that when you're looking at your net worth, which according to accountants is assets minus liabilities is net worth, your asset is the property itself, the gross value of the property. Let's say it's a $1 million property, and minus the liability of the loan. And let's say it's a $700,000 loan. If that's your whole portfolio, your net worth is $300,000. You can't call yourself an accredited because you own $1 million property.
No.
It's what your net worth is. So in that regard, it does count against your net worth. So as long as you're calculating your net worth properly and you make it to the accreditation, you're fine. The mortgages don't matter. What matters is how much equity you have.
And or how much income you have. Now, another thought, and we've already beat this drum, but just looking at your experience and what you're doing, you might consider being that syndicator, rather than wait till you can buy another rental property, put together a package of rental properties and you become the syndicator. Now you can require all of your investors to be accredited, but you don't have to.
That's right. When you're the principal, you automatically are eligible. You're fine. So if you're a principal on the deal, you're fine. And you again, we say this all the time. I know people get tired of hearing it, but it really is. Syndication is absolutely the best opportunity in real estate. It's the easiest way to do real estate. People think it's easy to start small and work your way up, but it's actually easier to start a little bit bigger because you have economies of scale. You can partner with experienced people. You get into teams fast. And then you are able to hire help to handle all the specialty stuff. You don't have to know as much, you don't have to do as much, and you get to play at a much bigger level, and you're diversified. You can diversify better. It really is a superior way to approach real estate investing once you get to the level where you either have enough money to pull it off passively or you have enough experience to be a principal, and I think you're there.
Great questions, Chase and Jason. We've got more on the way, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2021 Goals Retreat, January 8th to 10th in beautiful Lake Las Vegas, Nevada. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events, or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the live in-person 2021 Goals Retreat on the second weekend of the new year. Click Events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi there, this is Danielle DiMartino Booth, author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into this show. We're back to some live events, and we're doing virtual events. We're doing other people's events. We're doing our own events. You can find out all about the Real Estate Guys events, where we'll be and when, if you go to the website at realestateguysradio.com and just click the tab that says, wait for it, Events. It's Ask the Guys today. Your questions, our answers. Before we continue with our great questions, it's time for us to ask you a question as we play Real Estate Trivia. That's your chance to win a prize. As soon as you hear the question and think you might know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. The first person that guesses correctly will get an awesome book called Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. It's a collection of amazing stories from awesome women. That can be yours if you know today's real estate trivia question. Last week we had Ken McElroy on the show, and we asked this. There are 538 electors in the U.S. Electoral College representing the 50 states and the District of Columbia. All jurisdictions use a winner-take-all method with the exception of just two states. Which ones? Well, the answer is Maine and Nebraska, where it's possible to split the votes. Here's our real estate trivia question for this week. Name the happiest city in America. Yeah, of all the cities in America, one has to be happy. This is, by the way, based on a 2019 Wallet Hub survey. If you think you want to know, maybe you live there, maybe you know someone that does, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address. We'll need that to send you your prize, Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That's today's real estate trivia question. It's Ask the Guys, your questions and our answers. If you have a question for the Real Estate Guys, just go to the website at realestateguysradio.com. Click the button that says Ask the Guys and fire away. We certainly can't answer every question, and we rarely answer them personally, but the best ones that appeal to a large audience make it onto the show. This one comes from Lynn in Longmont, Texas. Hi, guys. I can't tell you how positively influential your show and conferences have been to me. The ideas and guidance have propelled me to now own a solid, knock on wood, single-family rental portfolio. I give you lots of credit for that. Okay, so that's a way to maybe get your, question higher to the list to pay us a nice compliment. Well, thank you very much for that, Lynn. My question is about reserves. I'm just coming from the virtual New Orleans Investment Conference, so of course I'm buzzing about the need to have some precious metals in my portfolio. What do you think about holding some reserves for properties in cash for emergency needs, but the rest in metals? I think repairs and maintenance prices for homes will go up, and I want to preserve the purchasing power of my reserves just as much as I want to preserve the purchasing power of my personal funds. Do you see any negative to this idea? Again, I sincerely thank you for all you do. Well, that is not a middle-of-the-road standard way of thinking, Lynn, but I like it.
Yeah, no, congratulations. I think it's great. Obviously, if you're going to buy precious metals, you take currency risk because you're moving out of the dollar, and the dollar and precious metals like the dollar and other currencies move in different directions from time to time. Sometimes that's in your favor and sometimes it's not. So the question you have to ask yourself is whether or not you believe that long term the dollar will fall relative to precious metals, meaning denominated in dollars, precious metals would go up. Obviously, if you were at the New Orleans Investment Conference, which is kind of a gold conference, got its roots in it, a lot of people are what they would call bullish on gold, meaning they expect the dollar to fall and the price of precious metals to go up. But I would say, just like the old adage in stock investing or paper asset investing, a balanced portfolio of 60-40, if you had 60% equities and 40% bonds, you're considered to have a balanced portfolio against inflation, deflation. If you look at your cash reserves or your liquid reserves the same way, you could say, okay, I'm going to hedge against deflation by having some dollars, and I'm going to hedge against inflation by holding some gold or precious metals. And now you look at that and you adjust your asset allocation model, if you will, to either be more weighted to cash or more weighted to gold. But here's another concept to think about. If you look at your operating accounts, your bank accounts, if you own properties, you got money coming in, money going out, money coming in, money going out, and every dollar that comes in is spoken for and it's going back out. But if you just look at your bank statement on any given day and look at your daily average balances, there's always a positive number there. That's called float. And if you know when you look at your statements, hey, my bank account's never been less than $200,000 ever. I've always been able to manage my current payables with the income coming in and never been below $200,000. You might say, I feel comfortable taking half of that float and putting it into precious metals, plus some of my reserves. And so that would be a way you could weight more heavily towards precious metals. Now, you do have some friction. If you sell the precious metals, there's a couple things are going to happen. You're going to have potentially a transaction cost. You usually get the transaction cost on the purchase, but you're going to have tax. And you have to factor that in. So if you're doing it inside of, this is a tax strategy, but if you did it inside of an entity that had the benefit of some real estate losses, you might be able to mitigate those taxes. So that's too much to go into for this question.
And you want to check with your tax professional.
Yeah, but the point is that love the way you're thinking because you're recognizing the potential for the dollar to continue its 108-year slide. And the benefit of owning some precious metals in a portfolio to mitigate that risk. And the obvious place to do it is when you have to stay liquid. Gold is very, very liquid.
So I think most real estate investors understand the idea of reserves. Your lender is going to beat it into your head, right? The lender is going to require you close with some reserves. I can't take all my money and put it into the down payment of the property and then hope the rent comes in the first month, right? And it's prudent to have some reserves. In fact, we would suggest that every month when the rent checks come in, you set aside a little bit for reserves. This gets back to the first question early on. How much? Well, part of that depends on the property. If I buy a brand new property from a builder with a 5-year builder's warranty, then I'm not going to keep as much in reserves as I will if I buy a 100-year-old Victorian house, right? Because it's just more things that might go wrong. The other concept when it comes to reserves is this. Our previous question came from a gentleman that has 6 different properties. If you have 6 different properties and you're keeping reserves for each of those properties, pretty soon you start to realize, much like your idea of float, Russ, that, hey, my reserves are piling up here. I don't need all these reserves for every property all the time. So you might decide, well, I might be able to put some of those reserves somewhere else.
And you can take it a step further, because if those 6 properties are all in the same neighborhood and the neighborhood burns down or has a flood or something happens, well, then maybe you need a little bit more because you have market exposure. Whereas if those 6 properties are spread out over 6 markets, you probably have less. So the concept is understanding the more diversified you are, the odds of every property in every neighborhood having a problem all at the same time are small if you're diversified well, and then you can bring your crash reserves down. If you are concentrated either in a single property or a single neighborhood, then your reserves need to be a little bit higher. And then again, you have to look at the types of properties, to Robert's point, that you have, and the types of tenants that you have, and the types of risks that the marketplace have. Those all factor in, right? It's very different to be maybe in Florida where hurricanes happen all the time versus being, maybe in Oklahoma where tornadoes happen or whatever, versus being someplace else where nothing happens, hardly ever. So you have to look at all of those things.
Well, and there's another mindset here to get your brain around, and that's just the idea is as you scale up, as you have more property, you just need to rethink this stuff, right? In this case specifically, if that works for you and you feel confident with maybe a little of your reserves in gold, you go along for 6 months and you go, you know what? I could put a little more in gold. Maybe then I could put some in silver.
Well, so here's the thing. We talk about this a lot. It's one of the things that I wished I would have known in 2008. But if you've listened to the show, you've heard me talk about SWOT analysis. I'm enamored of it, right? It's strengths, weaknesses, opportunities, and threats. And if you have a discipline that every so often, maybe once a year, you review your portfolio, maybe each property, each marketplace, including your teams, just everything you've got going on. You look at what's going on in the marketplace, all the way down to what's going on with the tenant. And so you do it on a rotating basis. You don't have to do it like all and take 3 weeks off, and just concentrate. You just kind of you're constantly evaluating what are the strengths that I have, what are the weaknesses that I have, what are the opportunities that I have. A lot of times you'll find you have idle equity. That's one of the biggest opportunities I always find in people's balance sheets. They get equity just sitting there doing nothing. And then threats. And of course, we're spending a lot of time on threats, but the more threats you find, the more mitigation you're going to need. Cash cures a lot of problems. Insurance solves a lot of problems. Diversification can solve some problems, and maybe you decide you're too concentrated, but you learn that by going through the mental discipline of what's called a SWOT analysis. And when you get in the habit of doing it, you'll start to recognize things pretty quickly, and you'll know what to do.
If you bought a single-family house as a rental, I can't imagine you wouldn't get insurance. Your lender's going to require it. You're going to want to make sure that if something catastrophic happens, you're covered. My friend that has 100 houses, he doesn't have insurance. Do you know why? Because he's what we call self-insured, meaning he has so many houses that literally the cost of paying an insurance premium on 100 houses times 100, right? That's a lot of money. Rather than pay that to an insurance company to accept the risk, he sits on that pile of cash and he takes the risk. Now, that's a very advanced strategy. There's companies, big companies domiciled across the world that don't pay insurance. They're self-insured. So it's just a way of thinking about it. And this is a big boys and girls concept, is not just, I put some money away for this, I put some money away for that. You're strategically thinking about how do I get the most out of everything. My reserves in this case. So we could probably go on and on about some ways, and even infinite banking in terms of cash reserves, but you're on the right path, and love the way you think. You'd want to work, obviously, to make sure that if you're going to set those reserves aside, that you understand, metals are liquid, but there are those costs involved. So do the math, and the math will tell you what to do. It's Ask the Guys. Your questions are answers. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, the editor of the Gold Newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit. In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hey, this is John Asraf, and you are listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. If you lack clarity in your life, if you need more focus and passion, then come on out to create your future, the 2021 Goals Retreat. We're all ready to put 2020 behind us and make our plans for an outstanding next year. The event takes place in Lake Las Vegas, Nevada, January 8th, 9th, and 10th. You can find all the details on our website at realestateguysradio.com under events. It's Ask the Guys today, your amazing questions, and our attempt at answering them. If you have a question for the Real Estate Guys, just send an email to ask@realestateguysradio.com. This next question comes from Carlos in San Antonio, Texas. Hey guys, I tried to find self-storage syndicators within your website, but couldn't find any. Can you please point me in the right direction? All right, well, first of all, we have what we call providers. Those are kind of, our radio sponsors and people that help investors live out our motto, education for effective action. And some are syndicators who do all kinds of different types of real estate deals. But as Russ said earlier, we're not matchmakers. So it's not like you can go to our site and say, I want this and I want that. But there are definitely people in our tribe that are syndicating self-storage.
Well, there's two things to this. First of all, we aren't matchmakers in terms of matching people to deals, but we do have a methodology for introducing people to people. And that comes in a couple different forms. On the website, under the resources tab, you'll see the investor registry. And if you go to the investor registry, you can fill out a form, a profile, if you will. It's like a bridal registry. Hey, if somebody comes to my party, this is what I hope they bring, right? You fill that out. And then because we're us, people bring us deals all the time. And we can't do every deal that we see. We can't do most of the deals that we see.
Right.
And so we just introduce people, say, hey, we've got somebody in our database that's interested in self-storage, and you do self-storage, then maybe we'll just send you contact information. And we don't send your contact information. We send you their contact information, and then you guys can get together, and that's up to you.
We never sell leads. We never give our database to anybody. But when someone raises their hand, like you have, Carlos, and said, I'm interested in self-storage, I want to come alongside a syndicator and passively invest in self-storage. Well, awesome. We have people in our world that do that.
And then the other way to do it is to get involved in the live events. Come to the events. Come to the Secrets of Successful Syndication seminar, because there's hundreds of people in the room and maybe somebody's going to be doing what you want to do. Get involved in your local investment club. If you really want to get involved in self-storage, go to a self-storage conference, because when you go there, you're going to see all kinds of people that are in the business, and many of them are going to be in the booths trying to raise money, and you can compare them one to the other. You can see who's smart, who's respected, who looks put together, who looks a little bit not so put together, right? You can learn a lot. We're big fans of trade shows, big fans of conferences, big fans of clubs, getting together with people and getting into the ecosystem, getting into the network. And if you do those two things, I think you'll find that plenty of opportunities will be coming your way.
Ironically, Carlos, at our last Secrets of Successful Syndication 2-day workshop, which was virtual, we had two of our featured speakers, both of whom syndicate self-storage. That's not why they came, was to talk about self-storage, but they both happened to do that. So had you been in the room, you would have met not one, but two of those guys. So you're not going to find it on our website, but you might want to sign up for investor registry, so then proactively when those things come out, you'll hear about them. All you have to do is go to the website at realestateguysradio.com under the resources tab. It's Ask the Guys Your Questions, Our Answers. Wish we had time to get to them all. We'll get to one more. And this one comes from Wenganga from Kampala, Kawempe, Uganda.
Wow.
I think this might be our first Ask the Guys questions from Uganda. So how do we not answer this? Hey guys, I'm a Ugandan and I'm wondering if you can help people like me to invest in real estate in international markets. All right. Well, thanks so much for listening. Thanks for writing. We don't directly help people, but as we were just talking about, we do have a lot of resources. And I think we might be able to shed some light on some ideas about how you can live where you want to live and invest where the numbers make sense.
Yeah, I think the first thing it's a big world. You got to have an idea where you want to go. If it's United States, well, then you're going to want to build relationships with people in the United States. If it's another country, then you're going to want to build relationships there. We, in our career, have started out in a single neighborhood, then we moved out to another city, then we moved to another state, then we moved across the country, then we moved out of the country. And then Robert actually went all the way to the other side of the world. I never went on that trip because it was a 17-hour flight and I wasn't interested in that. But the point is that it comes back to the theme. It's kind of been a theme throughout the show today, and that is relationships. You get into relationships with people. And the great news is, because of things like podcasts and videos, like on YouTube, we have a YouTube channel, there's opportunities to either post comments or respond to offers of free reports and to fill out contact forms and get on people's mailing lists and start gathering information and learning about things. And then when you get the opportunity, if you're able to travel, come to some of these trade shows and visit the markets that you're interested in, build those relationships. If the part that you're at is, can we help you in terms of getting ready to do all that stuff? Well, you have to look at that yourself. If you have the means, if you have good income, you've already made some successful investments wherever it is you are, Uganda, then you can leverage some of that money. I wouldn't bet the farm on outside investing. Always invest in what you know, but take a slice of it and say, I'm willing to risk this capital and invest it in learning a new market, building relationships, and actually purchasing something. If there's other people in your sphere of friends or associates right now that would be interested in doing that with you, maybe you could go in partnership with them and do some things and mitigate some of the costs and mitigate some of the risk. Or maybe, again, another theme is you say, well, I'm willing to do all the work, and you go get other people who just want to put in some money and fund you to go do the work. That's another way to do it. So there's lots of ways to do it, but it involves getting out. And I know that the world has been under lockdown. It's not as easy as it has been in the past. It may never be as easy, but what we've lost in travel, we have gained in technology. There are ways to join virtual networks and virtual conferences and get to know people, the virtual trade shows. So take advantage of all of these things and look at the different resources that you have. The strategy is always about, how can I take what I have to get what I need to get where I want to go?
The reason I've said live where you want to live and invest where the numbers make sense for a quarter century is that not everyone lives where it's good to invest. I don't know where you live. I know that the area of Uganda you live in is the big capital area, but I don't know the real estate market there. Never been there. Sounds like a great place to come check out. So there may be opportunity right there, but if there's not, the minute you decide, and this is for whoever is listening anywhere in the world, the minute you decide to consider investing in another country, there's just a whole bunch of education you need. You've got currency to think about. You've got qualifying for loans to think about. It's possible for foreign citizens to buy property in the U.S., and we have a lot of listeners that do that, but the loans are different. You need to have more money down, those kinds of things. So absolutely, positively, we're cheering you on, and you can explore around our website to get some resources and some ideas and keep getting educated for effective action. So thanks, Wanganga. Wonderful to hear from you in Uganda. If you have a question anywhere in the world, just reach out to us by going to the website at realestateguysradio.com. Click the button that says Ask the Guys. We've got a great show and a great guest next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening. And we'll see you next week, right here on the Real Estate Guys Radio Show.